So many people have gained so much equity in their house because of the low interest rates, the low inventory in the housing market, and because of this crazy 2020 to 2023. But with the market shifting, the interest rates rising to over 7%, selling your home to access your home equity might not be the best decision, because where would you go? So in this video, we will be going over what home equity is, how to access your home equity without selling your house, and stick around to the end because we will be going over exactly how you can use your home equity to purchase real estate and purchase cash flowing assets. What's up, everybody? Welcome back to my channel. If you are new here, my name is Evan Phoenix, and this channel is all about real estate education and my journey to financial independence through real estate investing. So if that's something that you're interested in, consider going down and subscribing below. I recently utilized this by pulling from one of my properties and purchasing a cash flowing asset for $0 out of my pocket. So as you can see, when done correctly, you can have tons of opportunities to purchase cash flowing assets and build your wealth. So what is home equity? Home equity is the difference between what you owe on a property and what that property is actually worth. For instance, if you bought a property for $250,000 and you owe $200,000, your equity is $50,000. But over time, your equity tends to increase because of a few factors. The first being loan paydown. When you first purchase a property, if you use financing, you typically get a mortgage on the house that you purchase. And with that mortgage, it will be paid over a certain amount of years monthly. And that monthly payment includes the principal and interest to which you pay back the bank for loaning on your property. But month after month, as you pay your payment, you slowly build equity as you pay down your loan. For example, if you take a $300,000 house at a 5% interest rate amortized over 30 years, your monthly principal and interest payment would be $1,610.46 a month. As you can see here, the first month you would be paying $360.46 towards the principal, in turn increasing your equity. Now you might be thinking to yourself, hey, that's really not a lot of money to be paid towards my equity each month. Well, it is because banks require you paying more interest at the front of your loan rather than later in the loan. The reason being, if you were to refinance, sell, they just want to make sure that they can capture as much interest payments as they can in the front of the loan. Which, when you kind of think about it, it's very smart. So on the same example, if you were to take the whole year's worth of principal payments, it would actually total around $4,426. But in year 30, you would be paying actually $18,812.15 towards your principal, which is a lot more. But just keep in mind that your monthly payment stays the exact same if you get a fixed rate. Now, the second way that your property tends to increase in value is because of appreciation. Now, typically, appreciation is a slow way to add value to your property. And the reason being is because in your area typically has to develop, build more homes in the area, bring more jobs in, more like-kind properties in your area would have to sell, so that way that you would have a gauge on what you could sell your property for. And there's a lot of economic factors when it comes into play with actually appreciation. So if you were to purchase somewhere in Los Angeles, then your appreciation would probably grow at a faster rate rather than if you were to be in the middle of Wisconsin. A good way to think about appreciation is supply and demand. The more supply and less demand, your property typically would not go up. But the more demand and less supply, then your home would appreciate at a higher rate. Appreciation typically plays in part when you've been living in a property for a longer period. But another way to add value is to add value to your house. As generic as that sounds, something like adding a bathroom or converting a large square footage into an extra bedroom, or finishing a basement that's unfinished right now. Those are all ways to add value and add more square feet to which you can charge more when you go to sell. So if you purchase a property and then add a 1,200 square foot detached garage, that's going to add value to your property. Now, one thing I will say with adding value through renovations on your house, but you really want to be confident in the numbers when you go to renovate your house or add updates by adding value. You really want to be confident that you can get that money back out when you go to sell. An example of that is if you go and purchase a property and in the very back left corner of the property, you build a mini putt-putt arena. And basically you put $50,000 into this crazy mini putt-putt setup. But when you go to sell it, you get very angry that no one else really wants a mini putt-putt arena in their backyard. So that 50 grand that you spent on it is just out the window. Now that's a very far-fetched example, but you just want to be considerate in what you're putting into your property to then get it back out when you sell. So how do you you access this home equity instead of selling your property? Because as we know now, there's not much inventory and the interest rates are probably double to what we have locked in our home right now. The three ways are a home equity line of credit, a cash out refi, or a home equity loan. A home equity line of credit is basically a revolving line of credit to which you can use similar to a credit card. Watch out because it does have a variable interest rate so that if the market does go up like it's doing now and interest rates rise, well then it's based off of the prime rate in which it would raise the rate of your interest rate. So you're paying more on the money that you use. Typically, HELOCs are used over a 10-year period of time, and then a second 10 period of time you spend paying back the principal. So ultimately, you have a HELOC for about 20 years. You can use it for the first 10, but the second 10 is just paying back the interest and the principal. The reason I really like a HELOC and why I personally have a HELOC is because you do not have to start paying on it when you get approved for a HELOC. You only start paying if you use money from the HELOC. That way, if you just have it sitting there in case of an emergency, you're not paying anything on it. Now, cash out refinance is basically taking out another loan and having it buy out your loan that you currently have on your property, but it's at a larger amount so that you can take out cash and put it straight into your bank account. Now, the cash that you will receive from a cash out refi will be untaxed. So you can use that money as you will. You don't have to save any for taxes at the end of the year. Now, the one thing with the cash out refinance is when you go and get that larger mortgage, you're going to have a larger monthly expense, a larger monthly payment on your property every single month. For instance, if you had a $1,500 monthly mortgage every single month, and then you do a cash out refinance, you take 50 grand out, you have that $50,000 in cash, your new monthly mortgage may be somewhere up close to $2,000 a month. So although you're paying an extra $500 every single month, you also have $50,000 of liquid cash in your account. So you really just want to weigh the pros and cons, and how you spend that money is going to determine if it's worth it for you to take out a cash out refinance. Now, the third is a home equity loan. It's very similar to a home equity line of credit. The only difference is it's a fixed rate and it's a loan. It's just like any type of car loan. With a home equity loan, they will give you the money and you will start paying on it right away, regardless if you use it or not. So if you want to take out money for a specific reason, a specific purchase, then a home equity loan may be the best route. If you just want a revolving line of credit in case an investment pops up that you want to act on, well then a home equity line of credit may be best. And if you have a good amount of equity in your house and you don't mind having a higher monthly cost of living, then a cash out refinance may be best for you. Now let's get into how you can use your home's equity to purchase investment properties. The first thing I'd like to say is that using your home equity to purchase a cash flowing asset is what I believe is the best use for your home equity. It's the people that end up using their home equity for a new shiny car, a brand new house that they're just gonna live in, or just fancy materialistic things that don't add any value and ultimately decrease in value over time. That's when you run into a lot of problems. By taking out a home equity line of credit, cash out refinance, or a home equity loan like we just talked about, you're able to use that money to go purchase a 2-unit, 3-unit, 4-unit, whatever type of investment property that provides cash flow every single month. So not only do you want your investment property to cash flow enough to pay for the expenses that comes with that property, you also want to think about the investment that you took out and what you're purchasing. What I mean by that is if you take out a home equity line of credit, you use the money and you have to pay $500 a month on it, make sure that it cash flows enough to pay all the expenses for its property and also to pay off that $500 loan fee for the home equity line of credit. And the same goes for a cash out refinance, or it goes for a home equity loan. If you want to see a specific example of how someone takes a home equity line of credit or their home equity in general to purchase an investment property, I made a video on my channel that you can watch right here that goes over exactly how I was able to use my home equity in one of my 4 units to purchase a cash flowing duplex. And get this, I put $0 down on it. The best thing about it though is that anyone can do this. So if you're interested, I go over all the numbers and exactly how I did that right here. Other than that, if you enjoyed this video, please go down and subscribe to my channel and give this a thumbs up for more real estate investing content. Thank you and happy investing.